Welcome, and thank you for tuning in to ESG Talks, a KBRA podcast series focusing on environmental, social, and governance, ESG. This podcast series highlights various ESG hot topics and includes commentary from prominent voices within the ESG community. In this episode of ESG Talks, Kerr, KBRA's head of European research, interviews Ken Egan, an associate director on KBRA's Sovereigns team. Gordon and Ken give an overview of the European Union's net zero plans and delve into how the EU's climate mitigation strategy may impact the credit profile of sovereigns in the region. They also discuss a recent Centre for European Reform research piece highlighting the need for the EU to remove tariffs on environmental goods.
Thanks for joining me today, Ken. The European Union's climate change mitigation strategy has been relatively aggressive as Europe targets a transition to net zero. In the current environment with Nord Stream 2 timing now in question and the cost of energy increasing, it's even more pressing to transition the European market away from fossil fuels. Perhaps we can start our discussion today by covering the topic of the European Commission's climate mitigation strategy and its net zero targets.
Sure. So the EU has played a key role globally in advancing environmental focused policy, starting with the first ever green bond issued in 2007 by the European Investment Bank. The European Green Deal, created by the current sitting of the European Commission, is the EU's current blueprint for climate change mitigation in the region, with a focus on reducing emissions, addressing energy poverty, and reducing external energy dependence, all while spurring economic growth and creating jobs. The EU has set a binding target of net zero greenhouse gas emissions by 2050 and plans to reduce greenhouse gas emissions by 55% by 2030 compared to 1990 levels. The EU also has a goal of 40% renewable energy use by 2030. This is in line with the goals of the Paris Climate Agreement, which commits members to limiting global warming to under 2 degrees Celsius, while urging countries to pursue additional climate change mitigation efforts that will limit warming closer to 1.5 degrees. Additionally, the EU has implemented the EU Emissions Trading System, which is the world's first large-scale emissions cap and trade scheme. Since the Emissions Trading System was introduced in 2005, emissions from power and heat generation and energy-intensive industrial installation sectors have been reduced by 43%. I think within this, for the EU, the transition of the transport sector will be vital and represents a cornerstone of the overall strategy. This is a sector which is responsible for a fifth of EU emissions. Hopefully that gives a high-level overview of the EU's climate change agenda.
Thank you very much, Ken. As we all know, there is a difference between the European Commission's intentions, its mandates, and of course the individual sovereign members' enaction of those plans. With respect to environmental planning, how are they all working together to meet climate goals?
Yeah, so the EU has overarching climate goals for the region, but EU member states are also required to develop long-term climate strategies and details on how they plan to meet the goals of the Paris Agreement. Member states are expected to prioritize funding to meet climate goals, but the EU also provides extensive money for climate change mitigation. The EU has a proposal of at least 25% of expenditures focused on climate action in its long-term budget from 2021 to 2027. The EU has a modernisation fund that provides money for investments in renewable energy, energy efficiency and storage, and the modernisation of energy grids, among other environmentally focused projects for the 10 lower EU countries. The EU also has a recovery and resilience facility that provides COVID-19 recovery funding, while also prioritising sustainability and climate action. As part of the funding, sovereigns must allocate at least 37% of received funds to green projects and a further 20% to digital transition. Now, some sovereigns will allocate more to green investments than others, like Denmark, where 59% of their recovery and resilience plan supports climate objectives. There are other frothier issues that will come to light too, particularly in regard to minimum energy taxation, which is due to come into effect. Traditionally, some sovereigns within the bloc don't like the EU dictating taxation, as it infringes on their own independent authority.
So climate actions in Europe are not a new phenomenon. There's been plenty of action done already. There remains a lot to do. And as you highlighted, there are plans in place to progress the climate agenda further in the years to come. However, maybe it's worth just quickly highlighting some of the additional climate-related plans and targets that EU sovereigns have achieved already and are currently in place.
We published a surveillance report on Germany in November 2021, and the sovereign has an impressive environmental strategy. Germany is one of the few advanced economies globally that has legislated to be carbon neutral by 2045. Germany has reduced its greenhouse gas emissions by 41% compared to the 1990 levels, and in June 2021 passed new climate legislation setting higher emissions reductions targets for 2030 of at least 65%. Germany also aims to phase out nuclear power by 2022 and coal reliance by 2028, while the government's plan for renewable energy to generate 65% of the power by 2030. The introduction of Germany's sustainable finance strategy was another landmark announcement in 2021. As major investment and financing is needed in order for the sovereign to transition to carbon neutrality, this new strategy will help allocate capital towards green and sustainable projects. Additionally, the government plans to use a traffic light system that makes it easier to recognise green and sustainable investment opportunities. This is an innovative and leading approach to green financing. German industry also progressively invests in climate action. According to the Federal Statistics Office, industry enterprises spent a total of €3.5 billion in 2019 on systems to prevent emissions or enable resources to be used more efficiently. But policies also have knock-on effects. For example, Germany passed a Supply Chain Act, which will force larger companies to perform due diligence with regard to human rights for workers and the environmental impact all along their supply chain. So it has far-reaching tentacles, given the sovereign's place within global trade. Germany isn't the only sovereign with impressive targets. Denmark has greenhouse gas emissions reductions targets of 70% by 2030 relative to 1990 levels. The Irish plan includes reforms related to climate change. For example, Ireland will introduce a reform of the climate governance framework and enshrine climate neutrality by 2050 into law. Spain, France, and many other sovereigns have plans that will see major renovation of residential homes through this decade in order to reduce demand on energy. I think there's common harmony across most plans with regard to electrification of the transport sector, greenhouse gas reductions, and home renovation plans. I think there's common harmony across most plans with regard to electrification of the transport sector, greenhouse gas reductions, and home renovation plans. It's important to note that there is also heightened stakeholder interest in climate mitigation, which is helping to push environmental policy to the forefront for many EU sovereigns. The European Investment Bank released its 2021-2022 climate survey, whereby 81% of respondents in Italy were in favour of stricter government measures that impose changes on people's behaviour with regard to climate action. 72% of Italian respondents would favour a tax on products and services that contribute most to global warming. So EU citizens and voters are closely watching progress on environmental policy and targets in the region. There is electoral momentum behind these plans.
Great, thanks, Ken. Now, what has sparked this podcast is a research piece written by Sam Lowe and John Springford from the Centre for European Reform, with a report titled "The EU Should Remove Tariffs on Environmental Goods," which highlights, as indicated in the title, the need for the European Union to remove environmental goods tariffs. Their premise is that by taxing environmental goods, one inflates the end cost of environmentally positive goods and products, restricting their growth and expansion. If their premise is correct, in your view, what would removing tariffs mean for climate mitigation in the EU? And how would this aid in meeting net zero emission targets?
Yeah, as noted in the piece, the EU currently imposes tariffs on several goods that aid in climate change mitigation, including parts for wind turbines and electric vehicles. The article notes that a previous study by the European Commission found that removing tariffs on environmental goods could reduce carbon emissions by 10 million tonnes by 2030 alone, while lowering prices by close to 1%. The authors highlight the 10% tariff on imported electric vehicles, which increases the cost to consumers and limits access for EU car buyers. The EU had discussed a policy on environmental goods with members of the World Trade Organization in 2014, but negotiations failed. One of the biggest issues that member states could not come to agreement on was what an environmental good is. For example, Lowe and Springford note a disagreement between EU and China on considering bicycles as environmental goods. I think China wanted bicycles included in the list, the EU did not. The removal of tariffs for environmental goods is likely to face backlash from the EU suppliers and producers, And member states may worry about an over-reliance on external countries such as China for electric vehicles and battery production. But as the piece notes, the world needs to decarbonize as quickly as possible, and barriers that limit the sale of environmental goods may need to be removed in order to achieve net zero goals by 2050.
So, turning our attention to investors struggle with connecting ESG efforts with the impact on their investments. So, the credit impact of these policies is not necessarily straightforward. As we transition towards a more sustainable future, how do these various policies impact upon sovereign credit, and what are the challenges that lie ahead from a sovereign perspective?
I think the main pressure point for sovereigns is the cost of becoming environmentally sustainable. There are plenty of figures thrown around about the huge investment sums needed annually in order to finance this transition. And I guess on the one hand, timing couldn't be worse. We just came out of a pandemic where spending for sovereigns increased, as did debt. Public debt is elevated, and fiscal balances are stretched. Meeting the EU's Fit for 55 plan alone will require public investment, government funding, and a shift on taxation. Public investment will be strong, but will it be enough? The European Investment Bank will support investment in climate action to the sum of around €1 trillion over the next decade. The other question for sovereigns is, will this green investment contribute to growth, or is it purely about sustainability? It needs to create exportables to foster growth, but also jobs, which enables a multiplier effect for the economy. Overall, it seems there might be positive effects on productivity and employment, but public finances and growth could suffer. On growth and economic activity, as we just discussed, tariffs will be a big part of this. Tariffs are a barrier to trade and growth, but average global tariffs on environmental goods have fallen by about 1% over the last 20 years. But there are differences across jurisdictions. Tariffs in developed countries, say for example in the EU, tend to be higher than developing countries. Again, if the goal is climate action and sustainability, then the removal of environmental goods tariffs means we get to targets quicker. I think one obvious area for funding is the sovereign green bond market, which has exploded with demand over the last 18 months. In fact, what we're seeing is there's so much stakeholder demand, and because of the nature of green sovereign bonds and transparency, government agencies can't keep up with actually allocating and implementing the funding, creating this some sort of bottleneck. I also want to note that these dynamics are not exclusive to sovereign credit analysis. In fact, KBRA's Project Finance and Infrastructure team just released its European and UK 2022 outlook, highlighting the EU's focus on expansion in renewable energy and the emergence of newer asset classes linked to energy transition.
Thank you for highlighting that. You can find those on KBRA.com. And on top of that, we just released a separate podcast on the topic as well. Now, turning to the rating agency side of things, we here at KBRA think about climate mitigation and net zero differently to the other agencies. We concentrate on evaluating both the physical risk and the risks associated with climate transition and their impact on the creditworthiness of the issuer. How does this evaluation get incorporated into KBRA's credit analysis of sovereigns?
Stepping back for a minute on KBRA's approach to ESG issues more broadly, we believe many ESG issues, including those that relate to climate change and mitigation efforts, are inherently management issues. And so we call our approach for corporates, financial institutions, and governments ESG management. ESG factors increasingly pose challenges and opportunities for issuers. Some may be near-term, some may be long-term. But an entity preparing and strategizing for anticipated risks and opportunities will likely have a stronger management profile, which has always been a key component of KBRA's analysis of corporates, FIs, and government issuers. An analysis of management's ability to respond to ESG issues helps get at the interconnectedness of ESG considerations. Most environmental and social issues, for example, are inextricably linked. And so it helps to think about it in terms of ongoing management of ESG risk exposure and ability to capitalize on opportunities. Now, in our analysis of sovereigns, climate change is an overarching factor with the potential to affect many sectors of a country's economy and can influence debt sustainability. Where relevant, we assess both physical and climate transition risks. Physical risks, such as extreme weather, sea level rise, drought, can directly affect sovereigns in the short, medium, or long term. The short and medium term physical effects of climate change could result in falling economic output, balance of payment issues, and or stress on sovereigns' public finances. The long term effects of physical risks may lead to lower potential growth, and displacement of human capital, or conversely, create economic opportunities for many sovereigns. Transition risks refer to a sovereign's ability to adapt to global policy or demand changes. Economies that produce large quantities of greenhouse gas emissions may be significantly exposed to transition risks. KBRA believes it is credit relevant to understand policymakers' awareness of and planning for potential changes in international or multilateral climate-related initiatives. It is also important to understand how sovereign works with its various jurisdictions and states to meet climate goals, as well as how it interacts with other countries and regions on climate planning. Importantly, most sovereigns are signatories of the Paris Climate Agreement. To meet the terms of the agreement, these sovereigns must focus resources on climate-related mitigation efforts and may need to significantly restructure their economies to reduce greenhouse gas emissions and invest in green technology. This may include investing in green energy such as wind or solar, expanding access to electric vehicles and electric vehicle infrastructure, and adopting regulations to curtail emissions in high-emitting industries such as manufacturing, transportation, and among other measures like that. We highlight these topics where relevant in our rating reports under the ESG management section. As of right now, however, it's important to note that ESG considerations may be among factors driving policy, but this momentum does not directly drive the rating for EU sovereigns in general. In terms of what drives credit risk, KBRA looks to how policy, ESG or otherwise, affects the important macroeconomic variables in an economy. And by this, we mean the impacts on fiscal indicators, growth, employment, inflation, and access to financing over the medium term to long term.
Great. Thank you very much, Ken. It was an interesting discussion.
Thank you to Gordon and Ken for a very interesting discussion. Please email esg@kbra.com with any questions or comments. We also encourage you to visit KBRA's ESG website at esg.kbra.com, where you can find ESG research related to the topics discussed in this episode, further details on KBRA's ESG approach, and other ESG-related media items. You can also join our mailing list to access our ESG Weekly Roundup newsletter. This concludes our episode. New episodes of ESG Talks air every other week. In the meantime, please visit kbra.com to access our other podcast series as well as our ratings and research.